So about 2 weeks ago, the SEC removed the ban on general solicitation, which I thought was a really interesting thing, and I decided to talk about it. So for those who don't know, general solicitation is selling shares in private companies to regular people via commonly accessible public channels, like advertising on print, news, TV. And the reason they decided to do this was to facilitate the passage of the Jobs Act, which came out recently, which is intended to democratize access to capital through what's known as equity crowdfunding. So it's a little different than crowdsourcing. It's a little different than the kind of what you see on Kickstarter. What it is selling equity shares in a company to regular people for small amounts of money. So everyone can be an investor. So investor protection advocates think this is a horrible idea. They see it as opening the door to boiler rooms and scams and, stealing money from grandma. But it kind of opens us up to an interesting question, which is, what is the proper role of government in protecting investors? And what kind of regulatory regime do we really want to see put into place? Because the thing is, regulation is inherently reactive. And there we go. It's reactive. And so, what that means is it largely happens not as sort of like this holistic concept about the system that we want designed. It happens in response to something that was fucked up. So usually this happens in the context of some sort of crisis that's happened, a bubble that's burst. It started back in the Securities Act of 1933, which was a response to that there, which is the stock market crash of '29, which led to the Great Depression. And so the interesting thing about that is it wasn't really fraud so much that caused that as irrational exuberance and this idea that the market had been running up for 9 straight years. So everyone had this idea that the market was only going to continue to go up, so they should buy in now. So this kind of did open the door to fraudsters who would come in and sell crap companies with no disclosures. So in an attempt to restore confidence in the market, we got the Securities Act of 1933, which was where general solicitation was first banned. But a lot of other regulators of the day thought the problem isn't regulation, the problem is fundamentally people, and people making bad decisions because they're looking to kind of have an easy win. So over the next 50 years, what happened was we put in these standards for accreditation, which is the idea that certain people can buy certain things and other people can't. And wealth became a proxy for sophistication. And so what you see there are the criteria that you have to meet in order to invest in a private placement. But the thing that was interesting is that kind of despite that, even in the public markets, we saw this kind of run up again, this irrational exuberance leading into the internet, the crash in 2000 following the internet bubble, which happened concurrently with the Enron and Tyco frauds, and led to this idea that despite the protections that were already in place, we still needed to be doing more. So we got the Sarbanes-Oxley Act, which was this idea that we should be increasing penalties for fraud. And again, all of these regulations are done more in an attempt to restore investor confidence in the public markets. And so we had this again in 2008, which was very, very recent, and this was a different kind of bubble. This was kind of the housing bubble, which burst and then led to this kind of cascading effect of other problems that revealed kind of endemic problems in the financial system, which led us to Dodd-Frank. But the interesting thing about that was that as recently as 2008, we were saying we need to protect consumers. We need to prevent people from buying dumb things. And so you have the CFPB is established as a result of this legislation. And we basically have this steady trend of 80 years of increasing investor protection by strengthening disclosures and trying to make sure that people don't do the wrong thing. But the interesting thing is, through the 2008, the recession following the 2008 crash, there was this weird idea that came out that Silicon Valley was still hot, and startups were doing great, and Facebook and Zynga were trading at these insane valuations in limited private placement markets, so everyone should be able to invest in startups, because startups don't go down, it's all upside. And so what we get is we get this legislation, the Jobs Act, which is passed and kind of, pardon? Oh, well, don't hold that thought. Exempting growth companies from disclosure requirements and saying, we need to make it so everyone can buy into this. And we have this weird idea, we're talking about an asset class where 75% of startups actually fail, but we have this push for deregulation with this kind of like populist agenda, and it's possibly the first time in history that that's ever happened. So there are kind of some interesting corollaries that go with ending the ban on general solicitation, which is it's not just startups that can solicit now, it's hedge funds, it's banks, it's a lot of the other people who in 2008 we were saying we needed to be protecting people from, who are now suddenly able to come out and pitch you on TV about investing in their various funds. And then there's the other factor, which is right now the way the market system is, you can buy in, but you can't get back out. You're going to be holding this investment for the next 10 years because there simply isn't any infrastructure in place that's created kind of this robust market. So in essence, there's been kind of this idea that, in response to the question I was asking earlier about what the proper role of the government is that where startups are concerned, we shouldn't be worried. We shouldn't be saving people from themselves. But everywhere else, we still should.